Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Thanks again for joining me for another monthly edition of the Market Update. Hope everybody's having a good summer so far. I know it's not exactly what you had in mind. We were hoping to go up to North Carolina, maybe enjoy a little hiking, but of course we've had to reset our plans, and we're going to be hopefully doing some staycations around here now that we have the boys home, although they have been home for a while, but done with school at least. um, I hope you guys enjoy the video though. It's insightful one as always. Remember, if you want to get the more detailed version, you hang on after the credits and compliance slide, and you'll get the more detailed version for a few extra minutes. But thanks again for tuning in, and I hope you enjoy it. Okay, so we always like to start off with the asset class returns. And here we have the returns for the month of May and also year to date. So you could see the S&P 500, the large cap, and the small cap both up nicely again for the month, making up for a lot of the losses, up about 4.7 and 4.3. The S&P is actually only down about 5% for the year. It's made quite a comeback. Now you can see here by the small caps year to date that part of the market is still lagging significantly. As you can imagine, it's the smaller companies that have really taken a bigger hit by this recession, and taking a bigger hit with COVID-19. On the other front, international, you look at developed market and emerging markets, both up also for the month, but developed markets has been very strong. In fact, has done better than the U.S. market for the month. So maybe there's a little rotation there. We'll have to see. Although I will tell you a little preview for June. We've continued to see that rotation, interestingly. So real estate has been up, but not up quite as much, so maybe slowing down. It has still a good way to go. It lost more than the large caps. So it's been recovering nicely, but still a good way to go. And when we go to fixed income, on the fixed income front, both the high yield and the high quality fixed income are up for the year now. The higher quality, of course, up more, up about 5% for the year. But even high yield is up now for the year, a little over half of a percent. And as the market comes back, you can see how high yield for the month has actually improved quite a bit more. So that has been good to see. And of course, having that fixed income has been a huge help, especially in March when everything was really ugly, just to hold things up a lot better. Last one is gold. You can see gold has done very well for the year, up the most 14% plus. Still up some more for the month, which was pretty strong, but starting to maybe slow down a little bit as the market makes nice moves up. It does tend to not go up quite as much, and we'll talk a little bit more about that at the end of the video. But you'll see even at 1.52 for the month, that's still pretty strong. So those are the returns for the market, and we'll talk a little bit more about what's been going on. So the main theme for this month's video is the rally continues. Last month, I introduced a slide that showed what are the drivers for the rally and what are the risks to the rally. And so we're still really along the same theme. I just updated the slide with some of the latest news and happenings. And so here on the rally side, what's driving it is reopenings have not created a spike so far. So reopenings continue. We're almost completely reopened for every state, not fully, but to a certain extent in every state. We're still waiting for some of the bigger states, but for the most part, things have been going pretty smooth. Now, that's not to say there hasn't been a few spikes here and there, but nothing yet that has alarmed anybody that was truly unexpected. Secondly, we have stimulus globally expanding. What we're talking about here is really just this week we heard about Europe expanding their monetary stimulus about another 1.3 trillion euros, which was more than expected, and expanding the time frame that they're going to apply it. So we're seeing not only the stimulus here in the U.S., which we talked about last month, which was massive, not only by the Fed, but also through Congress, but now we're starting to see the same happening all around the world. And I just highlighted Europe, but China as well. So those are very good signs that it could keep the rally going as long as we continue to see more of that stimulus come through. Of course, we also have here in the U.S. Talks about expanding the current stimulus. As some of you might know, the unemployment benefits, which have been very popular and have actually been giving about 68% of the people receiving unemployment a raise from what they were receiving when they were working. It was a very generous benefit, but a lot of people are saying that we could still have a lot of shutdowns and the social distancing would be inhibiting jobs through past July. So what are we going to do in July? And so a lot of economic forecasters are seeing that Congress will probably have to extend those benefits. Maybe not as generous as they've had, but there's going to be some extension, and there could be other stimulus, infrastructure and some of those things that come along with it. So with more stimulus, again, more fuel for the fire here. And lastly, we have the continued hopes for a treatment and vaccine. Seems like every week there's a new contender for the vaccine, new treatments. AstraZeneca just announced a day ago that they're talking about having 2 billion doses available by the end of the year, most of them probably in 2021, but potentially millions in September and October. I mean, that's amazing. And so that continues to basically, fan the flames of this rally as it continues on. On the risk side, we have, things are opening up. Is everybody going to be back? And so that's a big question. I don't know how to answer that. I think the people that are more comfortable being back are already starting to do so. But there's a good portion of the population that's still very nervous about COVID and getting sick, especially folks that are on the more vulnerable side of the population for the disease. So that's still a question. How strong will this comeback be after things open up? We also have the permanent nature of the job losses in some cases. I just read a stat that bankruptcies for the month of May are up 48% from the previous year. And that's really, really high. Now, that doesn't mean that all those companies will disappear. Some of them are just reorganizing, but a lot of them will. And if the companies are gone, the jobs won't come back. Maybe they'll go somewhere else, but it's not going to be as smooth sailing, I think, as maybe the market is pricing in at the moment. And of course, I've talked to many of you, including myself. I'm concerned about potentially a second wave of COVID-19. Now, as things reopen, we know that the cases are going to go up a little bit. It's just a matter of how much. Certainly, the protesting and rioting here in the last couple weeks has not helped in that situation. There could be some massive super spreader events going on. But I just hope and pray that, it won't be that bad. Maybe the warm weather, maybe, a lot of people wearing masks will help. We'll have to see. But that is something that, is definitely a risk to the rally. China tensions continue to climb. This is actually getting a little bit worse, and I think as the market comes back, it seems like Trump gets a little bit more bold in his, I should say, in his tenor with the tensions with China, talking about Hong Kong and also potentially revisiting some of the trade deals that we made. So that is definitely a risk because we know what happened last year when we were in tensions with China and the trade deals. Lastly, we have the S&P 500 valuations are a little high. Not just a little high, actually pretty high. And so that's a big area of the stock market. And being that it's a very high valuation, how much higher can it go? Now, it's obviously predicting that maybe things are going to be better and earnings will be better than what's baked into the cake right now. Or it could just mean that there's a lot of optimism. And so anytime there's a lot of optimism and price to perfection, so to speak, I always get a little anxious with that because that could be a risk to the rally. Okay, so I've shared with you what's been going on, but of course you're probably asking, okay, Demo, that's great, but what is going to happen? What's your outlook for the next month or so here? And so first of all, it seems like the fundamentals have possibly bottomed. Now, again, if you stay on for the extended edition, I'll get into some more slides and charts about why I think that is a possibility. But it does look like it's gotten about as bad as it could possibly get, and maybe it was April and May. One of the signs that I'll point out here is just today we had our unemployment report that actually was surprisingly good. Everybody was expecting another 10 million, 8 million to 10 million more job losses for the month of May to compound on the 20 plus we had in April. And to everybody's surprise, it was actually up 2.5 million. I mean, it's amazing. It was actually the biggest jobs gain ever in a month. And so we went from expecting one of the worst to the best. So, I'm trying not to get too worked up about this because it is wonderful, wonderful news. Maybe it's the PPP that's hiring people back. Maybe it's just all those reopenings, but it's not going to be at full capacity. So maybe we're starting to see that, but it's definitely a very good sign. And as I'll show you in the extended edition, the numbers are about as bad as they could have possibly be gotten. So it's kind of easy for things to get better from the very, very bottom of the abyss. Okay. The next piece is basically what I'm seeing now is the market is pricing in a V-shaped recovery. And I'm still in the camp that this is going to be more of a U-shaped recovery. I want to be optimistic and I want to make it go up like a rocket ship like Trump said. But the reality is, like I mentioned with the risk before, there's going to probably be some issues that are going to crop up here and there. And so I'm being a little bit more conservative with what I see and how this recovery is going to turn around. So I guess I'm trying to say maybe the market's a little bit more optimistic overall than I am at the moment. I hope to be proven wrong. And so what are we watching? Just like what we were watching when things were really ugly, I'm continuing to watch oil prices, the VIX, and really starting to look more and more at the increase in the COVID cases as we reopen. The good news is really in all these fronts have been improving dramatically. Oil prices have stabilized, gone up. The VIX has been coming down. And the COVID cases, like I talked about at the update, even though we've been reopening, things have still been trending down. So that is all a very positive sign for the economy overall. And in fact, I think because of that, there's going to probably be some rotation from the really beaten down stocks, not the ones that held up good like the tech stocks like Amazon, Facebook, Zoom, some of those. It's going to probably be the ones that really took a licking, like the financials, the transports, the energy companies, and even international, that's going to start to come back around. You saw the performance figures year to date, the ones that had those worst year to date numbers. I expect to see a little bit of a rotation if we really do see these items that I've highlighted here continue to improve. And so what am I doing? We're continuing to stay with a neutral stance. So if your target 70-30, we're pretty close to the 70-30, continuing to rebalance. And of course, when we rebalance, we're not going to be buying the things that are expensive like large cap tech. We're going to be buying the stuff that's way undervalued, like the financials, like energy, like small cap, like international. And so we're going to be taking advantage of potentially the nice move up in those areas as we rebalance, and we will be continuing to do so. Thanks a lot. Okay, so for the educational piece for this month's video, I want to talk about what the Fed's been doing in what they call monetary stimulus. In this case, basically what a lot of people see as money printing. Now, are they really printing money? Now, technically, that's not really what's been going on. So let me show you this little chart here on the left. When Congress needs money, okay, they tell the Treasury, we need some money. The Treasury goes and issues bonds, okay? And what happens normally is the banks, as you see here, buy the bonds from the U.S. Treasury, giving money to the Treasury, okay, so that they can use it for, for paying the bills. Social Security, benefits, defense spending, and all that. Now, where does the bank get money? The bank normally gets the money from consumers, from us. We're the ones that buy the bonds typically. Now, it could also be foreigners, Japan, China, Europe. They're buying the bonds from the banks as well. And so that's how the money flows. It flows from the consumers to basically the Treasury, okay, through these banks. Now, what's been happening here recently is the Fed has been intervening. They've been kind of getting involved in the process. Because what happens if the Treasury needs more money than the consumers are willing to buy, okay, or maybe they want to lower the interest rates, what the Fed will do is they will buy money, they will buy the bonds, I should say, from the banks. Okay, so you can see here from this little chart, the Fed is putting money into the banks. Okay, and so instead of the consumers pitching in, here the Fed does it. Now you might ask, well, where does the Fed get this money? Well, this is where the digital printing of money is occurring. The Fed, unlike the Treasury, can just make money appear. Okay, I'm not kidding. This is really how it works. The Fed just adds zeros digitally to the balance sheet so that they could pay for these bonds. Okay, now they own these bonds. They put them on their balance sheet. And what happens is when they give the money to the banks, of course, the banks will then give that money to the Treasury. All right, so it ends up eventually into the Treasury, and so that's how the U.S. Treasury can basically what's called monetizing the debt. It never went through consumers, okay? They just created money out of nowhere, and they received this money so they can spend. Now, what eventually happens is that these bonds that the Federal Reserve owns will mature. And what happens is then the Treasury has to pay those bonds. So if the Treasury, I should say, pays the bonds that the Federal Reserve is owning, they are then taking money back that they had from the Fed that was made digitally. They're giving it back to the Fed and paying them back. If that happens, then money disappears from the monetary system. All right. Now, here's the trick. The Fed isn't necessarily always getting paid. They are basically accumulating more and more assets. That's why I have shown you this little chart here on the right. It shows the balance sheet of the Fed, and you can see how back here a few months ago, it has gone up significantly. Now, it went up a lot also in 2008, 2009, 2010 with all the quantitative easing, but it has gone up, as you can see here, dramatically. And now, are we going to be able to pay all that back? Probably not. And so, in essence, what's happened is now we have much more money in the system than we did before all this happened. And so what's the bottom line of this? When the Fed basically prints digital money, they're adding money to the supply of money in the system. And when there's more money and the same amount of stuff, usually what happens is inflation. Things get more expensive, okay? Now, as of right now, we're not really seeing a lot of inflation, because there's a little bit more to this that if you want to get into it, you can call me. We could discuss it more. But I feel that eventually, maybe not right away because the market's still struggling and recovering, but eventually as things start to get better, all that extra money that's floating out there is eventually going to end up getting spent, and it's going to be chasing the same amount of goods that are today, causing a lot of inflation. Now, some of you may have noticed over the last month or two that I've been adding gold to the portfolios. This is exactly why. When we looked at what happened in 2008, 2009 with gold and the same scenario with the Fed, gold prices actually went up quite a bit over the next 5 years. So assuming that something very similar is going to probably happen here, especially since this has been at an even bigger degree than back in 2008, 2009. Interesting, right? And finally, I want to leave you with a little bit of inspiration. I'm sure I'm not alone watching a lot of the nightly news the last week or so. It's been frustrating, you know. I must admit I've been getting a little upset watching the looting, people's businesses being destroyed, frankly some people getting beat up, even killed. It's been horrible, but also sad that there's still this much racial divide in our country. People getting killed, you know, probably because of their skin color. And so I know it's a little cliche, but things sometimes are cliche because they're true, and they should be commonly reminded of. And so what I want to leave you here is basically love is the cure. And I want to read you this verse from 1 John 4:19 through 20. If we love because he first loved us, if anyone says, I love God and hates his brother, he is a liar. For he does not love his brother whom he has seen, cannot love God who he has not seen. And so that was a little reality check for me as some of my anger got a little, pent up. And as I read this, I'm like, oh wow, I think I need to maybe act instead of with frustration, with a little more gentleness and love. And if we all did that, wow, what a difference we would make, not only in your community but in this whole country. So thanks guys, thanks for listening and watching, and hopefully we'll see you soon. On the Outlook message, I talked about how the market was historically at a high point. I wanted to show you this chart here that shows how the S&P 500 is currently valued at about 21, 22. That's the forward, the next 12 months earnings. And you can see that we're at a pretty high point. You might ask, well, isn't the market down? How can the stock market be expensive? Well, it's because the projections for their earnings, which is how they calculate the price to earnings ratio, has gone down significantly. Now, we don't know exactly what they're going to be until they happen, but the forecast is for them to be down. And so I think that's part of what's going on here. We're getting a disagreement to how bad those earnings are going to be. But as you could see, they're definitely forecasting for earnings to be a lot better than the consensus. And so that could be the case, or it could be kind of a danger sign that the market is too high. And so when it gets up to this level, we haven't seen these levels since 2001. I don't know if you remember, that was the time of the tech bubble. It's getting up there. That's what I mean by being priced to perfection. So it's kind of a warning that things are maybe getting a little expensive. Now here's a 5-day trend line of new COVID cases from Johns Hopkins University. And it goes all the way through June. So this includes a lot of the states that have been reopening. Now, mind you, not all of them have. But we haven't seen a major uptick in the new COVID cases. The growth is decreasing. So this is one of those optimistic signs that I was pointing to that could be really good for the market going forward. We'll have to keep a close eye on this though. Now on the outlook, I mentioned that things have gotten about as bad as they could get with the fundamentals. And this chart here shows you how this is the initial jobless claims. It comes out every week. This is how many people are looking for work, new people looking for work each week. And you can see how in the worst of it in March, it spiked up to an unbelievable amount. A pretty dramatic chart. But the nice thing is what we're seeing here is the numbers are coming down, consistently coming down. And as we now know from the May result, we actually saw a lot of people going back to work in addition to new people still looking for work. But more have come back to work in the month of May than were looking. So that's a very good sign. That's why we had some growth there. If you've watched any of my videos before, you've probably seen this chart before from Econ Pi. It basically shows all the different leading indicators, and then it shows this little red dot, which is kind of the average of where all those leading indicators are. And when it's up here, the market's growing. When it's over here, it's slowing down, and when it's down here, it's in the pits. And I don't know if you could see these dots, but they're pretty much all completely on the left. I've never seen that before. That's about as bad as it gets. That's why you heard me say the fundamentals are pretty much at the abyss. Okay, so pretty much anything will make things look better than this. And so I think we're seeing essentially the bottom of fundamentals, and things are hopefully going to start recovering here. It's just a matter of how quick. Well, over the last few months, I've been watching the VIX and oil and the new COVID cases. So with the VIX, we're seeing things continue to drop. And so the VIX, again, is that volatility index. It's kind of like how afraid is the market. And so we hit our peak fear over here in mid to late March, and it's been steadily coming down. So this is a good sign that things are starting to settle down with volatility and with the fear out there. Now the other component was oil. You could see how oil has made a huge recovery. It actually went into the hole, or negative. It looks like a hole in this chart, but it's come back dramatically. It's almost back to where it was pre-COVID. Not quite, but it's made huge strides moving in the right direction. And that's a precursor for global growth, essentially.